Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Ecora Resources PLC. Please note, you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Mark Bishop LaFletch, Chief Executive Officer of Ecora Resources PLC, which trades on the OTCQX Best Market under the symbol ECRAF, and on the LSE and TSX under the symbol ECOR. Welcome, Mark.
Thank you very much, and thank you all for joining us today for our presentation. Ecora Resources is a very simple story. Fundamentally, Ecora is a royalty and streaming business, and therefore we provide investors with relatively de-risked exposure to the mining sector and primarily to commodities. And unusually, as Ecora Resources, we also have constructed a portfolio of commodities which provides investors with exposure to the energy transition thematic. Based on our portfolio today, we are if not amongst, the leading royalty company providing exposure to the energy transition thematic. Very shortly, over the past, call it decade, we've built up this royalty portfolio of high quality assets and high quality growth prospects. We have an established track record of capital returns. One can evaluate our track record of capital deployment. We're very transparent as to how the acquisitions have performed. We've substantially improved our sustainability disclosure and thus our profile. And the opportunity today, which is why you're here, is an attractive valuation, or potentially a very attractive entry point. Our portfolio provides investors with three key thematics. And so from the top, the first thematic is exposure to renewable energy production. The second, the transmission of renewable energy. And three, the consumption or storage of that renewable energy. In time, our strategy is to build our portfolio in terms of our commodity exposure to be broader and to capture many different areas of that value chain. Nevertheless, the core of our portfolio today is copper, nickel, and cobalt. Ecora Resources has come through many different phases. Since I joined the company in 2014 in a different role at the time, but our key strategic imperative was to build an income profile that would effectively, on a sort of through cycle basis, roughly provide like-for-like income as one of our cornerstone assets runs off in 2026. And we've done that by acquiring royalties and a number of commodities, but very base metals heavy. Once we had done that, we turned our attention to adding growth to the story, which we've substantially added growth such that the royalty income profile has a potential to go upwards of almost 3 times in the medium term. And so now today where we sit with Ecora, we see it as our key strategic imperatives are to, number one, diversify the commodity mix. And by that we mean rounding out the exposure to really appeal to folks as this one-stop shop for low beta, low volatility exposure to the energy transition. And number two, to keep diversifying our counterparties such that through cycles and through normal operating conditions, our business is well positioned to perform well, regardless of short-term volatility and production profiles of the subcomponent assets in our royalty portfolio. In terms of our royalty portfolio itself, for folks who are familiar with the mining space, hopefully you'll be very familiar with our key counterparties. One of the interesting things about Ecora is that while Ecora itself is a small cap in terms of our market capitalization, our counterparties who are developing or running the mining operations are mega cap or large cap for the most part. And you can see that in our producing portfolio. If one were to add the aggregate market capitalization of the counterparties who own the mines, you'd have an aggregate market capitalization figure in around $200 billion. And so therefore, when one thinks about Ecora, it's important to keep in mind that Ecora is a smaller royalty company, yes, but that's very different to Ecora being a smaller company and developing a mining project. The folks who run the mining projects over which we have exposure are very large for the most part, and materially well positioned to develop mines. They have a lot of in-house expertise. They have all sorts of things in what you would want really to have a de-risk portfolio on the producing side. And turning to our growth pipeline, it's a very similar story. On one of our most important growth assets, it's a copper nickel royalty in Australia, in construction today and owned by BHP. And as far as growth options go, this is pretty spectacular. To our knowledge, there is only one royalty of this size and scale, and we own it with BHP as a counterparty. So that's something that we track very carefully, and is one that generally investors view very favorably. The next key growth asset in our portfolio is a copper and cobalt, royalty in Chile. It's a project owned by Capstone Copper. The project is called Santo Domingo, and that project is expected to come into production into the next few years. And similarly, our third key growth asset in the short to medium term is PLE, which is a nickel cobalt product produced in Brazil. It's a nickel hydroxide product, and in the world today, this product is incredibly strategic. There are very few sources of high purity nickel hydroxide products or MHP products available to flow into the United States as IRA compliant material that can be used in these supply chains. And so this project, as we understand it, has been attracted a lot of interest from strategic partners, and this project is expected to begin construction sometime next year. So that takes us to our growth profile. And this is something that, this slide, I think, really demonstrates how far Ecora has come from what the business was 2, 3, 4, 5, 6 years ago. The company historically was very reliant on one commodity and one asset, and that's this light blue line, which fades off to materially zero by 26. And then the solid blue line, which you can see on this slide, which overlaying an asset which is in construction at West Musgraves, and then the orange line in total provides a path for our portfolio to reach revenue in excess of $100 million, all from nickel, copper, cobalt, uranium, vanadium. In other words, commodities that are expected to face supply deficits and that have incredible futures based on what most market commentators have put forward, given what is generally very favorable supply-demand balances, generally tilted towards a soft supply ramp-up. Within Ecora, at the core of the business today is copper exposure. And in a world where copper 20 years ago was $1 per pound, and today it's somewhere around $3.54-ish per pound. With the royalty model, one can really clip top-line exposure. And this is really important. When one thinks about how do I get any exposure to copper, right? If one buys a mining company, yes, the mining company will benefit in time as copper price goes up. But on the other hand, a mining company often has cost inflation. And so in the example I just gave, when copper 20 years ago, say, was around $1 per pound, and today it's almost 4 times that, a mining company's margins have not increased 4 times. Whereas a royalty holder would have seen their income from that asset go up by a factor of 4. And so if one takes a fairly long-term view on these commodities, the royalty model is a great way to have inflation-protected exposure to long-term pricing trends. And really at the core of Ecora is copper. Copper is our largest NAV contributor. And as I mentioned on the last slide, in the coming years, we shall see, or it's expected to see, as a percentage, copper, nickel, and cobalt increasingly contribute to the bulk of our revenue contribution, with metallurgical coal running to effectively nil by the end of 2026. This slide really summarizes the opportunity and to some degree why most of you may have even dialed into the call today. I think there's no secret to anyone here today that capital market conditions are challenging. Or we've seen what seems to be a realization that high interest rates are here to stay for maybe for longer than initially expected. And Ecora, like many other businesses, have seen compression in share prices. But the opportunity for an interested party today, effectively with Ecora, is number one, exposure to the energy transition thematic. Number two, exposure to high quality counterparties. And number three, exposure to a entry point where today, based on broker numbers, the entry point is less than the producing portfolio. So in other words, the opportunity is to get the development portfolio effectively for free. So what comes next for this business and what could trigger a re-rating in the Ecora shares? Well, in large part, as we've just seen on the last slide, the development portfolio today doesn't appear to be allocated much value in terms of the share price. And therefore, what that suggests to us is that the market today is very risk off. And what the market would like to see is de-risking events tied to the growth that's intrinsic in our royalty portfolio. So this slide summarizes the key areas around the growth profile that we would expect that as time goes by would lead to more value being allocated to these development royalties. So the first is BHP's West Musgrave. I mean, this asset is currently in construction. It's targeted to be producing towards as early as the end of 2025 or the first half of 26. And therefore, I think this is one which just needs time. As we get closer to that date and as BHP progresses on the execution, that one we would have thought takes care of itself, so to speak. At Voisey's next year, a sizable ramp up is expected in terms of cobalt production and from 24, 25, 26 onwards. And we think the generally the market would react favorably to seeing steps forward in terms of the ramp up of the underground mining operation. At Piauí, the management team is currently exploring financing options. When and if the company is able to put together a financing package to fund the full construction of the project, of course, that would be seen very favorably. And between construction funding and today, there are other intermediary measures, which could include the Brazilian nickel announcing financial partners. As I mentioned, this project, to date anyways, appears to be attracting a lot of interest from battery manufacturers, for use in batteries from some strategic partners, including some well-known household auto manufacturers. And then last, probably most importantly, is some further indication of timing on the expected start date at the Santo Domingo asset, which is currently forecast somewhere between 26 and 28. Feasibility study in relation to the Santo Domingo mine is expected later this year. That asset is fully permitted, so it's shovel ready, so to speak. And a bit more visibility on the timing of the first income, we expect would be something that investors want to see that could trigger a re-rating. So to summarize, the Ecora story is probably one of the simplest stories out there. Number one, Ecora provides exposure to the energy transition thematic via the royalty model, which inherently provides investors with exposure to an equity that should have a lower beta and should have less volatility than a straight mining equity. Number two, the business has been positioned to deliver substantial growth in the coming years. And number three, it's been done with counterparties who are well-known names, blue chip operators in really attractive jurisdictions. Our portfolio, as I may have mentioned, but if not, our portfolio is almost 100% OECD exposure. So the right assets in what we consider to be the right jurisdiction. And with that note, we'll turn to some Q&A. So the first question I have here is, what are the catalysts for a revaluation of Ecora? Well, actually, I think we've just covered that one, but more than happy to dwell back into any further clarifications, should that be helpful. The next question here is, how competitive is the environment to acquire royalty streams for battery critical metals? There's two parts to that answer. The first part is, relative to the precious metals royalty and streaming sector, it's far less competitive. There are far fewer players. We very rarely go head-to-head with other royalty companies when we look to buy royalties and streams. And second, our biggest competitor actually is not other royalty companies, but it's rather debt or equity. So in other words, alternative forms of financing. And the royalty model shines particularly well at times when those two forms of capital are either more expensive or just not available. The equity markets today are really challenging. And so what we're seeing in the market today, folks who have good projects, who have great assets and the right commodities, but just can't raise capital. Not even, and if they can, at rates that are really, really expensive. And so relatively speaking, a royalty model, which typically is far less dilutive, is one that's viewed very favorably. The other point to make here in this answer is that the need for capital for the supply of these commodities to achieve the energy transition is enormous. And if one takes a view that we'll get halfway to a net zero scenario, or even the quarter of the way there is still an enormous need for investment to supply the minerals and to supply the metals required across the electric supply chain, so to speak. And therefore, we're looking to provide financing to a sector or to a commodity basket that is growing in terms of capital deployment at a far faster rate than precious metals or many other sectors. So the next question is, what is the makeup of your shareholder base and what can shareholders expect in terms of distributions? So in terms of the makeup of our shareholder base, our largest shareholder is a mining company. It is South32. South32, the history of that stake is tied to the acquisition of a royalty portfolio, primarily copper and nickel assets from South32 in just over a year ago now, where South32, as part consideration for that royalty portfolio, received Ecora shares. And at the time, which I believe still holds true, but the logic was that South32 felt that there was a lot of upside in terms of the assets that were vended into Ecora, and to some degree, I would certainly hope as well, within Ecora itself. And therefore, given they had a lot of positive, their outlook for this commodity basket was quite favorable, they were keen to retain some residual upside and exposure. The next biggest constituencies are institutional investors, a big chunk of them in the UK, but increasingly United States and elsewhere in the world, including Canada. And then last is smaller institutions, and then the typical register in terms of having a good chunk of retail shareholders as well. In terms of distributions, our capital allocation priorities have not really changed. It's a question we've had in the past couple of years, and the answer is the same, really, where the first priority is to have a strong balance sheet. As a royalty company, people, in my view anyways, invest in royalty companies for de-risked exposure to mining commodities, rather than going directly into a mining company. And therefore, by having too much leverage on the balance sheet, we could really erode what should be one of our key investment highlights. So having a strong balance sheet remains the number one capital allocation priority. The second is to grow the business. In the world today, asset valuations don't really reflect what's expected to be explosive demand growth across the commodity complex. And therefore, what we should be doing as a mining royalty company is deploying and buying royalties when commodity prices are relatively lower, and then increasing capital returns when commodity prices are much higher. And that's something that we feel we've done well in the past, and something that we'd continue to look to do. And then the third in terms of priority is shareholder returns in the form of cash and or buybacks. So the next is, the market is not giving you credit for future projects. Is there any liquidity risk for Ecora while we wait for those to come online, i.e. debt maturities, prior acquisitions, commitments, other? In our view, no. So today where we sit, our facility matures in 2025, although we'd look to refinance that well in advance. The largest capital outlay is a $70 million funding for the PLC project that is subject to final Ecora board approval, and therefore in some sort of disaster scenario, one could say that Ecora would not look to fund that project. However, to date, while of course is subject to final approvals, the PLC project is central to our growth strategy and is one that we're trying to be as supportive as possible to get that project built and running. So I mean, the future is uncertain, but currently we don't see any liquidity issues for the business. So I'll pause here for any other questions. Give it a minute. Okay, well, thank you so much for your time today. I know we ran through this content at breakneck speed, and therefore, if anyone would like a one-on-one, we are available to do that and go through any questions or the assets or the portfolio in any more detail. But in any event, thank you so much